Herkese merhaba. Londra-İstanbul hattında piyasalara özel bir parantez açalım. Yılın ilk 7 ayını geride bıraktık. Dünya ekonomisinde büyük başlıkların, aslında dönüşen beklentilerin, politika değişikliklerinin yoğunlaştığı bir dönemi yaşıyoruz. Şimdi yeni bir aya başlarken aslında hem küresel makro görünümde neredeyiz sorusuna birlikte yanıt arayalım, hem de yılın ikinci yarısına dair beklentileri, riskleri, fırsatları konuşalım istiyoruz. Bugün Deutsche Bank'ın Doğu Avrupa, Orta Doğu ve Afrika Araştırma Direktörü Christian Wietowska ile birlikteyiz. Hi Christian, welcome to our show.
Thank you very much for having me.
Let's start with the big picture. As we turn the page to August, where do you think we stand in terms of global macro trends and market sentiment? Is it time for a reality check, or are we still in a soft landing narrative?
Yeah, that's a very good question. I think we are entering the summer period where usually liquidity is a bit lower. We're seeing a lot of people obviously out of the office. Usually this tends to lead to quite significant market reactions in some cases due to some headlines. And also this time around, we had obviously some very important developments or very important announcements, particularly on the trade deal, which have been announced finally by the US administration last week. The most important one was obviously on Europe, where we now have some clarity with regards to what to expect. Our initial expectations of 10% of tariffs have not been met, so we are now getting 15%. However, the most important point for Europe and also for Eastern Europe is in particular that the automobile tariffs have been reduced also to 15%. So this kind of reduces the downside risk in terms of creating a potential trade war, which could lead to significant negative impact on global growth and on sentiment. So at the margin, this was definitely positive. However, we shouldn't forget that the impact of the tariffs still will be negative for growth going forward over the next few months. Our chief economist has estimated the impact on European growth around 0.5 percentage points of the tariffs. So yes, there is there is some uncertainty gone, but I think in the near term there's still a negative impact, obviously, from the trade deal on growth in the euro area in particular. And I think that was an important announcement. We also got, of course, an announcement of 25% for India. That was probably higher than expected. So we need to see whether there are still backroom discussions going on between both countries to bring these tariffs down. But I think the most important thing is that we now can estimate that there is definitely a floor in terms of the potential downside risk for growth in the second half of the year. And that has led to a rally in equities. Equities have performed very well. We saw a bit of weakness on Monday, but overall we are now at record highs in the US, and also Europe has recovered. So all this is definitely something has to do with the uncertainty gone on the trade front.
What's changed most is the level of euro, actually. So we have this trade deal, EU's trade deal with US, and we have ECB holding the rates steady last week. So how do you see from now on the euro dollar parity especially?
Yeah, that's a very good point. I think if on Sunday when the announcements came through on the US and the tariffs on Europe, I think most people would have expected this to have a positive reaction potentially for the euro. We also got a bit more hawkish stance of the ECB, implying that potentially rates will be on hold now for a prolonged period of time. It's a base case scenario, and also our house call has changed from expecting 1.5% as terminal to now 2% on the back of the last ECB meeting. So all this should have given a push. It should have been positive actually for the euro. However, we saw a remarkable sell-off, after weeks of euro strength and euro resilience, that despite kind of still underlying data being slightly better than expected, the trade deal through and a bit more hawkish ECB, we nevertheless saw the euro now collapsing. there are two arguments on this. On the one hand side, yes, there has been stronger data coming out of the US, a very resilient backdrop. The euro weakness has already started earlier this week, so the Fed meeting from the middle of the week had a bit of an impact because it was slightly more hawkish. But I would say it was more driven by other factors. And my feeling is really that we have seen a massive short position in the US dollar. So the entire market had been positioned very negatively on the US dollar over the next few weeks and months. And my feeling is that we saw a bit of profit taking, a bit of positioning unwinding. And this has led to this, kind of fast move in the euro weaker towards 114. So definitely something most economists and strategists would have not expected at this point in time. It can be related to lower liquidity over the summer, but and some of the underlying data more supportive for the US dollar. But I think the main argument is potentially that it was a positioning unwinding a bit more than a structural shift with regards to the euro-US dollar view.
What's your year-end parity forecast?
So we haven't changed our call for now. So our strategists still expect euro-US dollar to move towards 120. Our main
120.
argument is that so 120 is still our house call. This hasn't changed this week. The trade deal should at the margin be probably positive for the euro.
Yes.
Also to have some clarity, in particular the fiscal spending, the boom coming potentially out of Germany, bringing European growth high up for next year. This should give another kicker and should limit the downside risk in our view on the global growth picture, and that should lead to a further rebalancing of flows out of the US. However, there's definitely in the short term the positioning and these kind of fast moves that we have seen from everyone expecting euro-US dollar to move to parity by the end, at the start of this year now to the forecast going to 120, 125. I think this has also gone very excessive in that direction. So a bit of stabilization here is probably why we're seeing like a rebalancing of positioning a bit.
Okay, let's speed up. Let's come to Turkey. The rate cut cycle has begun. How much more easing do you expect from Turkish Central Bank this year?
Yeah, so the last meeting, the CBT surprised us by delivering 300 basis points of cuts. It was a touch more than expected. We had 250 basis points penciled in, but it wasn't unjustified, or it wasn't a change in stance from the CBT, as the inflation dynamics or the disinflation has been on track, inflation has been coming down. So it was fully justified to deliver a 300 basis points rate cut. We need to keep in mind that real rates in Turkey are quite high. Also, domestic dynamics have weakened a bit, so there's definitely a slowdown in domestic demand on the back of very tight financial conditions. So to cut rates by 300 basis points was absolutely in line with what was justified by the underlying picture. Going forward, we still have penciled in further rate cuts for the next few meetings, 250 basis points cuts for September and October, the September meeting, October meeting, and the last meeting of the year, 200 basis points. So to bring rates to 36%, this hasn't changed from our initial expectations of 36% by the end of the year. But there is a lot of uncertainty about the pace now of the easing cycle in the next two meetings. So due to the external backdrop as well, we shouldn't forget oil has spiked this week by 7-8% since last Friday. So if this continues, it makes it a bit trickier in terms of the disinflation in Turkey. So and this could then of course also slow down the easing cycle. We are not yet worried on dollarization in Turkey because of the rate cuts. I think the improvements in real rates are enough to offset that disinflation pressure dynamics. But I think this is also something to watch later in the year, particularly going into Q4, that if nominal rates or yields are much lower in lira deposits, that we could see an acceleration a bit in the increase in in dollarization, but still at very mild levels. But nevertheless, this could also slow down the easing cycle from the CBT a bit later this year. But the most important thing is we still believe the CBT will have room to cut rates further next year. And our house call remains that we still think rates can be cut further towards, below 30% in 2026 on the back of further disinflation and an improvement in overall domestic dynamics.
Short answers, please. What are your updated forecasts for TL and growth for Turkey?
Growth, we haven't changed it. We still believe growth will be around 3% this year and 4% next year due to improved loosening of financial conditions. We see a pickup in growth for next year. Fiscal should be a bit tighter. After being at 5% in 2024, we expect it to go to 3% by 2026. Currency, we expect continuous gradual grinding higher. That hasn't changed. Yes, we have seen a bit of a pickup in the pace of this kind of, I would call it managed currency at the moment. But this has weakened a bit more than most people would have expected, and also relative to forwards. However, the last few days, we see now a bit of a more controlled depreciation. I think this should continue. We still think that it goes to 45 by the end of the year versus the US dollar. But it should, in our view, still be real appreciation. So relative to the inflation dynamics, the month-over-month dynamics, we still believe that the currency will appreciate. This means we're going to have further disinflation on the back of that for next year.
And last question, expectations for the second half of the year. A new rate cutting cycle, Moody's upgraded country's credit rating, but mixed signals coming from the real sector. So how do you think foreign investors interpret this current macroeconomic narrative for Turkey?
So, of course, the shock or the turmoil what we have seen in March has spooked a bit of foreign investors, and we saw very high volatility and large outflows on the back of that. The market has stabilized. We are now seeing again increased interest of foreigners in Turkish assets. We have seen an increase into lira carry trades. We have seen an increase into local bonds. I think it makes sense at these levels. I think the bond yields are still too high in Turkey, and they offer attractive value from a medium-term perspective, particularly if the easing cycle continues. The economy, I think, there are challenges because financial conditions are tight and the real sector is struggling under that. But this is why the rate cutting cycle has now been restarted. And also, we shouldn't forget that yes, the tariffs are negative for Europe in Q3, but going forward, there's a lot of excitement about German fiscal spending and this impacting European growth. And this should be very positive for Turkey as well, particularly into going next year for the export market. So we are definitely still constructive, and the combination of falling inflation, of disinflation, improvement in terms of the global outlook on growth should help Turkey to grow next year and to improve basically growth dynamics. In terms of the credit ratings, I think it wasn't a surprise necessarily that Moody's now upgraded because they were still behind S&P and Fitch in terms of the credit rating. But further upgrades in terms of from here is not our base case scenario. From a fundamental perspective, fully justified for Turkey to move closer to investment grade. The challenge remains, of course, also on the political side a bit to see how that's going to play out over the next few months and quarters. And also, we need to see a prolonged period of disinflation. And I would be highly convinced if inflation reaches levels towards 20%, that there is, without an overshooting in terms of rate cuts from the CBT, I think that there is a good chance for more credit rating upgrades over the next few quarters.
Christian Vietoska, thanks for joining our program.
Thank you very much for having me. Thanks.